We're about to pull back the curtain on the one fundamental rule that keeps every single business in check. I mean, from a tiny corner store to a massive global corporation, this is what keeps them financially honest. You can almost think of it like the law of financial gravity, and it all comes down to one simple, elegant equation. So what is this golden rule? I'll give you a hint. It's not just make a profit or cut your costs. Nope, it's something much deeper. It's a principle that guides every single transaction a business makes, and it's really the bedrock of its financial stability. And here it is, assets equal liabilities plus owner's capital. That's it. That's the core of all accounting. The best way to picture it is like a balancing scale. On one side, you have everything the business owns. On the other side, you have everyone who has a claim to those things. And that scale, well, it must always, always be perfectly balanced. Okay, let's break that down real quick. Assets, that's all the stuff the business owns that has value. We're talking cash in the bank, inventory on the shelves, even the company car. Liabilities, on the other hand, are what the business owes to other people, bank loans or unpaid bills to suppliers. And capital, that's the owner's piece of the pie, their personal investment in the whole venture. The best way to see how this works is to actually build a business from the ground up, one transaction at a time. So let's start at the very beginning, on day one. So our story kicks off with the owner putting in 18,000 rupees in cash. This one little action is really the spark that brings the business's financial world to life. But how exactly does it affect our equation? Okay, so check this out. That one move immediately hits two sides of the equation. The business now owns 18,000 in cash. That's an asset. But at the same time, the owner's claim on the business, their capital, has also jumped by 18,000. See that? 18,000 on the left equals 0 plus 18,000 on the right. Perfectly balanced right from the get-go. So, great. Our business has cash. But you can't sell cash, right? You need stuff to sell, products for the shelves. So let's see what happens when the business goes shopping for some inventory. The business makes its first big purchase. It buys 7,000 rupees worth of goods. But watch how it pays. 5,000 comes from the cash it already has. But the other 2,000? That's on credit. It's basically an IOU to the supplier. Now this is a fantastic example of the equation in action. Our cash, which is an asset, goes down by 5,000. But our stock, another asset, goes up by 7,000. To make it all balance out, a new liability, the money we owe our supplier, pops up for 2,000. The numbers all shift around, but that scale, it stays perfectly level. And this shows so clearly the two main ways a business can buy stuff. If you pay with cash, you're really just swapping one asset for another. Your total assets don't actually change. But when you buy on credit, you get a new asset, the stock, but you also create a new liability. Both sides of that equation go up by the exact same amount, keeping everything in that perfect equilibrium. All right, we've got our goods. Now for the really exciting part, making a sale. This is where you see the magic happen, especially when it comes to the owner's stake in the business. So here's the deal. We sell some of our goods to a happy customer for 4,000 rupees. But we have to remember, those goods weren't free. They actually cost our business 2,400 rupees to get in the first place. And the difference between those two numbers? That's the key. That difference is 1,600 rupees. Now, this isn't just revenue, this is profit. And in the language of accounting, profit has a very, very special place to go. Let's follow the money here, nice and slow. First, our cash asset goes up by the full 4,000 from the sale. Easy. Second, our stock asset goes down by its cost, 2,400. But wait, that leaves a gap of 1,600 rupees, doesn't it? So where does it go? It flows directly across that equal sign and gets added straight to the owner's capital. This is the crucial part. Because profit isn't just some extra cash floating around. In accounting, it represents a real, tangible increase in the owner's value in the company. Every single profitable sale makes the owner's slice of the pie just a little bit bigger. So after all that, the investing, the buying, the selling, how do we get a snapshot of the company's financial health all at once? Well, that's where a super important document called the balance sheet comes into play. So let's put together the final balance sheet for this little business we've been building. We're going to add up all our assets and all the claims against them and see that final, perfectly balanced picture of our company. And here it is, the final tally.
On the asset side, we've got our cash and our leftover stock. And on the other side, we have the claims, what we still owe our suppliers, that's a liability, and the owner's capital, which you'll notice has grown because of that profitable sale.
And just look at that, 21,600 on both sides. It balances to the rupee. This is the accounting equation in its final form. Every single asset the company owns is perfectly matched by a claim against it, either from creditors or from the owner. It just works. And this isn't a fluke or something that happens most of the time. No, it has to balance 100% of the time, every time, without exception. It really is the law of financial gravity.
So, if you're going to remember three things from all this, make it these. First, every action has a reaction. Every transaction hits at least two spots in the equation. Second, that balance, assets equal liabilities plus capital, is completely non-negotiable. And third, and this is maybe the most important part, profit is the fuel that grows the owner's value in their own business. In the end, the accounting equation isn't just a bunch of math. It's the language of business. It tells a crystal clear story about where a company got its resources and what it's doing with them. So the next time you look at any business, maybe even your own personal finances, just ask yourself, what story are these numbers really telling me?